There are more US dollars outside of America than inside it. More dollars sitting in foreign banks, foreign wallets, and foreign reserves than in the entire US economy combined. Let that sink in. So what happens to your dollar if the world decides it doesn't need it anymore? That's exactly what we're breaking down today. And I promise, by the end of this, you're going to look at your wallet very differently. Hopefully not in a crying way, but no guarantees. Quick question. Why does an Argentinian buying Chinese sneakers have to pay in US dollars? Argentina, China. Zero Americans involved, and yet, dollars. The US wasn't even in the room, didn't grow the cotton, didn't make the shoe, didn't ship the box, and yet, their currency is on the receipt, rent-free. Why does Saudi Arabia sell its oil in dollars? Why does a Vietnamese factory invoice a German retailer in dollars? Why does literally every international commodity, oil, gold, wheat, get priced in a currency from a country that didn't produce any of them? Because after World War II, America made a deal. The whole world was broke, bombed out, rebuilding from scratch. America was the last economy standing, factories running, gold reserves full, military power nobody could match. So America walked into a conference in Bretton Woods, New Hampshire in 1944 and basically said, hey, use our currency. We'll be the world's financial anchor. Everyone pegs to the dollar, stability for everyone. And the world said, fine, you're buying anyway. That agreement made the dollar the world's reserve currency, the global language of money, the thing every country needs to hold, trade, and survive in the international economy. But here's the part that didn't make it into your high school textbook. That deal didn't just make America important, it gave America a superpower, an unfair, embarrassingly one-sided advantage over every other nation on Earth. Understanding that superpower is the entire point of this video. A French finance minister in the 1960s had a phrase for it. He called it the exorbitant privilege. And honestly, the French guy was right, which is a sentence I never thought I'd say. Here's what it means in plain English. Imagine there's a party. You printed the tickets, so you never actually have to buy a ticket. Everyone else does. You just walk in, every time, for free. That's America, just walking into the global economy, unannounced, unbothered. Because everyone in the world needs dollars to trade, to save, to pay debts. The US can print money and the rest of the world absorbs it. Every country parks dollars in their reserves. They buy US Treasury bonds. That global demand keeps America's borrowing costs low, the dollar strong, and lets the US run deficits that would bankrupt literally any other country on Earth. Let me put numbers on this. The dollar is involved in nearly 90% of all currency trades on Earth. Not 60, not 70, almost 90. 58% of all central bank reserves worldwide held in dollars. Between 1999 and 2019, 96% of all trade invoicing in the Americas, dollars. 74% across Asia Pacific, also dollars. That is not dominance. That is a monopoly, with extra steps. And for decades, this worked beautifully. The world made stuff, sold it to America, got dollars, recycled those dollars back into US Treasury bonds and the stock market. America got cheap imports, cheap borrowing, and a standard of living it didn't fully earn. The stock market went up. Americans got richer on paper, and the rest of the world kept showing up to work. Beautiful system, if you're America. If you're everyone else, well, you showed up to work. That's something. But here's the strange part. For the first time in decades, some very powerful countries are quietly preparing for a world where that monopoly doesn't exist anymore. And they're not being loud about it. That's what makes it interesting. Here's where I give you something most finance channels won't. Actual numbers. Not vibes, not fear, numbers. In the year 2000, the dollar made up 71% of all global foreign exchange reserves. Every central bank on Earth running on dollar fuel. Today, 56%. That's a 15 percentage point drop in 25 years. And it's accelerating. In 2017, it was 64%. By mid-2025, 56%. Nearly 9 points gone in just 8 years. This is IMF data, not a Reddit thread, not a YouTube conspiracy, the International Monetary Fund. Now, some economists will say this drop is partly just math. Other currencies got stronger, so dollar holdings look smaller in percentage terms. True, partially. But that's like saying you only partially lost your wallet. Still lost. Because here's what those economists won't tell you. Central banks are physically buying less US Treasury bonds and physically buying more gold. The share of gold in central bank reserves has more than doubled, from under 10% in 2015 to over 23% today. China alone has been on an 11 consecutive month gold buying spree. Reserves now sitting at over 2,300 tons, valued at $283 billion. India is buying, Turkey, Poland, Singapore, all quietly stacking gold instead of parking money in treasuries like they used to. Why gold specifically? Because gold cannot be sanctioned. It doesn't live on a US-controlled payment network. Nobody can freeze it with an executive order. And that is the real story here, the thing most finance channels completely miss. This isn't about BRICS building some dramatic new currency. That's a headline. The real move is quieter. Countries are building an exit from the dollar's ecosystem, one gold bar at a time. Okay, fourth wall, right here, because I know exactly what some of you are thinking. So BRICS is replacing the dollar, America collapses, we all move to a cabin in Montana, stockpile gold bars, and start a newsletter called I Told You So. No, stop, come back. Here's the actual thing happening, and this is the breaking money perspective. The dollar isn't being replaced, it's being hedged against. There's a massive difference. When you take out insurance on your house, you're not saying your house is going to burn down. You're saying, just in case it does, I want to survive it. That's exactly what central banks are doing right now. Not dramatically dumping the dollar, quietly insuring against it. And when the smartest, most well-resourced financial institutions on the planet start buying insurance against something, that's a signal. To understand where this story goes next, you need to understand something genuinely strange about the United States. There are actually two Americas, and they want completely opposite things from the dollar. America number one, financialized America. The America we've lived in for the last 40 years, built on a strong dollar, cheap imports, rising asset prices, expanding debt. In this version, America's biggest export isn't cars or food or technology. It's dollars, treasury bonds, financial paper. A strong dollar made your iPhone cheap, your clothes cheap, your car payments manageable. It made Americans feel rich because everything from overseas cost less. And it made it very easy for corporations to borrow cheap money and pump their own stock prices instead of building anything real. This America needs a strong dollar. The banks love it. Wall Street loves it. Your 401k loves it. America number two, productive America. The version that actually builds things, runs factories, makes steel, grows food. The America that gave working people jobs with their hands, not their spreadsheets. Here's the brutal irony. A strong dollar made this America impossible, because a strong dollar makes American labor expensive, which means every global company has more incentive to build in Vietnam or Mexico than in Ohio. The same dollar strength that made consumers feel rich quietly hollowed out American industry completely. So here's the uncomfortable truth nobody in Washington wants to say clearly. A weaker dollar might actually be the medicine the real economy needs. It makes American-made goods cheaper globally, brings manufacturing back. It's literally the playbook China ran for 30 years to become the world's factory. But, and this is the part that matters for you, 40 years of financialized America means millions of people built their entire lives around a strong dollar world. Their mortgages, their retirement accounts, their whole cost of living. Weakening it means their lifestyle gets more expensive before things get better. That is the tension sitting at the heart of every policy debate right now. The Fed, the White House, the tariff wars, the trade drama. It all comes back to one question. Which America are we choosing? Okay, enough macro. Let's make this brutally personal. Here's what a slowly weakening dollar already looks like in your life. Not hypothetically, right now. Your grocery bill. America imports roughly $3 trillion in goods every year. When the dollar weakens, every import gets more expensive, and that shows up at checkout. You're already seeing it. Eggs, groceries, electronics. The prices feel random and chaotic. They're not random. The dollar dropped over 10% in just the first half of 2025. That math shows up on every price tag, every single one. Your mortgage, your car loan, every debt you carry. The US government borrows trillions at low rates because the whole world wants to buy treasury bonds. That global demand is what keeps borrowing cheap, for the government and for you. If central banks keep rotating out of treasuries and into gold, that demand weakens. The government offers higher yields to compete. Higher government yields mean higher mortgage rates, higher car loan rates, higher credit card rates. Your personal debt is connected to all of this, whether you signed up for that or not. Now, this next one is the one that actually messes with your head. Your stock portfolio, and the trick hiding inside it. If you measure the S&P 500 not in dollars, but in gold, the market has actually lost value since the year 2000. Your portfolio number went up, but the measuring stick got shorter. You got richer in dollars, but dollars bought less stuff. The system doesn't lie to you directly. It just uses a shrinking ruler and hopes you don't notice. And finally, your savings account, which might be the politest robbery in history. The average big bank pays 0.01% interest on savings. Inflation runs 3 to 4% per year. Every year you sit in that account, you quietly lose 3 to 4% of your purchasing power. No dramatic heist, no villain. It just evaporates. And here's the breaking money take I actually want you to walk away with. This isn't a bug in the system. It's a feature. A weaker dollar over time systematically transfers wealth from people who hold cash to people who own assets, real estate, stocks, gold, businesses. The people who understand this game don't panic about dollar collapse headlines. They quietly accumulate real things and let inflation work for them instead of against them. That's the game. And now you know it exists. The obvious question: if the dollar is weakening, what fills the gap? Honest answer? Nothing clean. And that's actually the interesting part. The euro? The Eurozone still can't agree on a single bond market. Germany and Italy have been in a quiet fiscal Cold War for years. The euro can barely hold itself together, let alone run the world. The yuan? China controls its currency so tightly it literally can't be freely traded globally. Any country holding yuan reserves would be betting that Beijing doesn't change the rules overnight. And given China's track record of capital controls, that's a bet most central banks simply aren't willing to make. The BRICS currency? Oh, they tried. Called it the unit. Gold-backed, blockchain-based, revolutionary. And then, at their 2025 summit in Brazil, complete silence. Because getting Brazil, Russia, India, China, and South Africa to agree on a shared currency is like getting 5 families who actively dislike each other to share one bank account and one PIN. Not happening this decade. Not happening next decade either. So here's what's actually going on. The dollar isn't being replaced. It's being diluted. The world is quietly fragmenting into currency blocks: dollar zone, yuan zone, eurozone, bilateral trade deals in local currencies. No dramatic winner, just less American dominance. For 80 years, the dollar was the only language of global finance. Now different rooms are starting to speak different languages. The dollar is still dominant, but it's no longer the only option in the building. And that shift, even that subtle shift, changes the math on everything. So where does this actually go? Nobody knows, including me, including the Fed, including every analyst on Bloomberg who delivers their predictions with the confidence of someone who has definitely never been wrong before. But here's how I think about the 2 most likely paths. Pick which one you're preparing for. Path 1, managed inflation. The Fed lowers rates. Dollar weakens gradually. Asset prices keep rising in dollar terms. Stocks, real estate, commodities. But your purchasing power doesn't keep up. Life gets more expensive for people without assets, more comfortable for people who own things. The gap widens. The K-shaped economy becomes even more K-shaped. Fun for some, less fun for most. Path 2, the hard reset. Foreign investors lose confidence in US assets. Capital leaves. Interest rates spike. Asset prices fall hard. Short term, very painful. Think 2008, but with a currency crisis sitting on top of it. Long term, potentially healthier. But the people who get crushed in the transition are the ones who weren't paying attention. Either way, and I want you to hear this clearly, this transition favors people who own assets over people who rely on income alone. That's been true for decades. It's becoming more true every single year. Look, the dollar isn't disappearing tomorrow. It is still the most trusted, most liquid currency the world has ever built. That doesn't evaporate overnight. But here's the thing about slow changes. They're the ones that actually get you. The dramatic stuff makes the news. The slow stuff rewrites your financial life while you're distracted. Central banks are buying gold at record rates, not because they're panicking, because they read the room early. Countries are building payment systems outside US infrastructure, not out of hatred, out of optionality. And most people watching the news are still waiting for a dramatic headline that tells them when to start paying attention. That headline isn't coming. This is already the headline. The only question left is whether you're the person who understood that in 2025 or the person who figures it out in 2035 when it's already reflected in everything you own, everything you owe, and every price tag you see. All right, that's the video. Go touch grass. You've earned it. And if you want to keep getting financial reality checks that your financial advisor is definitely not going to give you, the subscribe button exists. It's right there. Completely free, takes 2 seconds. You'll probably still think about it for a week before clicking it, but when you do, this is Breaking Money. See you in the next one.